feels like it's high time then that we heard what the EU renovation loan concept actually is. And to introduce it, we have Peter Sweatman himself, so our host today, founder and CEO of Climate Strategy and Partners, and a long-standing expert within the energy efficiency financing space. He's the rapporteur for the Energy Efficiency Financing Institutions Group, and also for the G20 Task Group, the G20 Task Group lead on energy efficiency financing. He's been doing that for 5 years. And most importantly, I would say for today's event, he is the author of the blueprint for how an EU renovation loan could work. Go ahead, Peter.
Thank you so much, Sonia. It's great to have the opportunity to present our work to all of you. And thank you so much to all of the organizations who have, and individuals who have helped us shape and review and sort of promote this event, and will continue, I hope, to support this instrument over time. Some of you are speaking today, others' names appear in the report itself. All of you who have joined us today will be able to get a recording of this video as well as the report itself. And this presentation that I'm about to make will also be available to you, and it will be sent automatically by the system at the end of this webinar. So my job in the next 20 minutes is just to tell you what's in our report. So Alejandro, if you can go to the next slide. I'll do that. There are 3 main sections. The first describes the current physical state and financial state of buildings in Europe. The second describes what is an EU renovation loan. And the third describes what, aside from finance, is necessary. Next slide. So to set the scene, next slide. Really, most of you, I think, probably understand this, but it's worth repeating. Buildings simply have a long, useful life. Over 80% will still be standing by 2050. They use the lion's share, 40% of energy, and most of that energy is used in the form of heat. So again, to resolve sort of things, of course, energy is used in multiple forms, but that heat right now under the microscope comes mainly from burning fossil fuels. And of course, nothing technically prevents us from renovating. And in fact, 9% of buildings have some sort of renovation, albeit light, every year. 1% of our buildings have some energy performance impacting renovations each year, but only 0.2% factors below what is necessary to meet our climate and energy targets get optimized for energy efficiency. So on the financial side, residential buildings in Europe, of which there are about 100 million, are worth in total over 17 trillion euros. 70% of Europeans live in a home they own, and the total amount of mortgages is around 7 trillion. That leaves 10 trillion, over 10 trillion of home equity. That's the amount of value that there is above the amount of debt, and that's stored in homes. Now, of course, some of those homes, 8%, roughly speaking, are publicly owned. And in fact, 15% of European households own more than one home. Nevertheless, next slide, that leaves 50 million primary homes with their owner living in them that I feel are opportunities which are currently undertapped or under offered with respect to financing to help them deliver a resilient and a low energy future. Next slide. So in the report, you'll read a section that talks a little bit about consumer attitudes to renovation. This is not primary work that's been done by us, but it's been done by the International Union of Property Owners. Because I think when we talk about the EU renovation loan, we're talking about the middle of the distribution curve. So that's most people, as opposed to the edges of the distribution curve, which is, you know, people who can't afford things, or people who own enormous portfolios of buildings, let's say. So 44% of people don't renovate because they simply just don't think they need it. But 31% don't renovate because they don't have the funds. This is wanting to renovate. So there seems to me to be a large untapped reserve of people who don't have the funds to renovate, but who would like to renovate. And interestingly, below 10% don't renovate because of either a lack of information or a lack of qualified services, which they don't perceive currently as barriers. Next slide. I also, during this work, wanted to look at the economics of deep renovation. So in a very simple, from a very simple basis, these two slides coming up describe why we need certain components of the EU renovation loan, i.e. delivery of a low interest rate. So what this chart, which you may think is complicated, but no, sorry, Alejandro, if you go back one, this chart shows from statistics from BPIE, Buildings Performance Institute Europe. On the dark blue and then the light blue, you can see the cost in euros per meter squared of doing a deep renovation. The light blue, or the highest sort of blue, is the cost of a deep renovation divided by the European region. So south, west and northwest, southeast, northeast and central. And the bars superimposed is the upfront financial benefits of the present value of the energy savings at a 3% discount rate, which is the yellow bar, and then a 5% green premium. So assuming that in that area, as a result of doing the works, the value of the property is more. The 5% is the mid-range of what the JRC discovered, and what EFIG discovered is the classic increase in value that is associated with increased energy performance. So more or less covered over the long term for 30 years, and that explains the maturity of the ERL. But next slide, if you take a 15% discount rate, which is closer to the types of discount rates that people have in their heads, or closer to the discount rates that have been used sometimes to form European policy, you can see what I think explains why a lot of people don't do deep renovations. Those bars, the green bars and the yellow bars, don't reach the level of a medium renovation. So that just simply means, in my mind, unless you have access to low either grants or low cost financing, you won't be able to make economic sense of a renovation. But of course, that does not count the non-energy benefits, the improvement benefits of health, the improvement benefits of reducing CO2. That doesn't account for comfort benefits and any of the other associated. This is a pure economic calculation. Next slide. So what is the EU renovation loan and how will it address that? Next slide. So this is a definition used in the report. So we think the EU renovation loan is an EU-backed, privately contracted, collateralized loan that provides all homeowners fair and equal access to long-term financing for the deep renovation of their home. The funding is provided on a zero coupon basis, which I'll explain, with a repayment of principal and accrued interest at the EU borrowing costs upon the earlier of transfer sale or its 30-year maturity. Next slide. The components of that are important are the loans will have a single purpose, which is deep renovation. They'll be aligned with the EU taxonomy, significant contribution criteria. The zero coupon structure means that even though there is an interest rate, that interest rate will be established at the level of EU borrowing at the time of the loan, and the interest repayments will just roll up and be paid at the end or upon early retirement. The borrowing amount will be capped at the loan value. That just means you can't borrow more than your home's worth. They will be collateralized by the home, but on a junior lien. That means second to the existing mortgage if there is one. There will be an EU guarantee against any eventual insolvency or collateral insufficiencies. The interest rate level, today the EU could borrow at 2.2% over 30 years, so that it'll be struck if you got an ERL today, you'd get it at 2.2%. And these ERLs will be supported directly by a central bank liquidity program. If I look at this structure now from different perspectives, we believe that given that the Europeans need 35 million Europeans need 235 billion annually, which are the figures from the Commission from the EU Renovation Wave communication, the ERL can fill that enormous gap that you heard Robert earlier allude to. Next slide. If there are significant populations that are parts of vulnerable communities which simply don't have access to long-term, low-cost financing solutions, including elderly people who can't take out more mortgages, and those are the people suffering often increased energy prices and have relatively capped or fixed pension income, and for whom therefore a zero coupon structure would be very attractive, and young couples who perhaps have a mortgage but they don't have savings and they don't have any more headroom, or they can't borrow more under a traditional mortgage structure. So for those two significant homeowner population demographics, the ERL targets these income constrained but yet asset rich individuals by allowing them to borrow more against their saved home equity. Next slide. The interest rate's important, and this chart just describes, so there's something exponential about zero coupons, and that is if you borrow 20,000, for example, today, and in 30 years you need to pay back a compound interest rate of 5%, then the total you need to pay back is moving on 90,000. So the optics of that are very unattractive, even though your home may have been increasing in value much faster than that. The traditional historical home price or asset price increase for homes across Europe has been 5% since records began. So even though your home may be increasing in value faster than the debt, nevertheless, the optics are fairly poor. Clearly, at 2.2%, you'd be paying back in somewhere in the region of 33,000 euros in 30 years. Next slide. So this slide just shows the difference between the 235 billion needed and the 25 billion of recovery funds, according to Renewable Renovation Europe campaign, that have been delivered until now through the renovation and recovery plans to buildings renovation. So clearly we need to fill that gap. Next slide. And the provision of an EU guarantee provides, I think, up to 100% more leverage on the public budget. So it's really important to recognize that the components of the EU renovation loan, the guarantee, the TLT, the liquidity program provided by the central bank, are existing instruments already used. So the guarantee comes straight from the InvestEU program potentially, and the TLTRO programs already have existed for a long time and just need to be activated to focus on providing liquidity to lenders who deliver ERLs. Next slide. So this is kind of what it would look like. Thousands of retail lenders who are approved under the scheme could provide their clients with renovation loans, and they would be notifying the commission to take benefit of the guarantees under those, and they would be able to provide those as collateral for lending at the ECB at a privileged rate, providing them a positive funding spread on those activities. Next slide. It's important, I think, to have lenders lenders' interests aligned, which is why if you think about the market that would be created from 3.5 million transactions annually, I estimate that could be for ERLs around 100 billion. The distribution fees payable on 100 billion could be somewhere in the order of €1 billion annually. So this is a significant market, and I think for all the distribution and effort and administration that is required, certainly that distribution fees would be an appropriate part of that mix, and that would align the lenders' incentives to get involved with their clients. Next slide, please. This can also sit alongside existing programs. So it's not that member states are not doing things at the moment, they are. In fact, you have the Eco-PTZ, which is a zero interest rate loan to low-income families in France. You have KfW's promotional support programs for energy efficiency in residential buildings. And in Italy, you have the Eco-Bonus program, all of which could sit healthily alongside the EU renovation loan. Next slide. So moving beyond the financing and into what's necessary as a framework, both a regulatory and a value chain framework, let's take a look at what's necessary to support the ERL. Next slide. So as Robert mentioned, the Fit for 55 package containing the Energy Efficiency Directive, the Energy Performance in Buildings Directive, and potentially, I would argue, the opportunity next year to reopen the Mortgage Credit Directive, you have a series of regulatory and legislative elements that can help member states to ensure that there are high quality training programs offered, that energy data through energy performance certificates are made available to these individuals, that there are certification schemes available in order to ensure an upskilling of the EU renovation workforce, and new certified renovation advisors to work with financial institutions to ensure the quality execution of the ERL renovations. Next slide. How many renovation managers are needed? So this is a quick calculation you can see laid out on the right-hand side of the slide. Basically, I think that if you assume that a renovation project manager can do 10 renovations a year, to meet the 35 million European buildings units that the renovation wave is talking to, we would need around 350,000 accredited project managers. Again, talking of scaling things up, when you take things from a size of 25 to 35 billion to a size of 235 to 275 billion, you are talking about factors of people working in this space. At the moment in Germany, for example, the KfW and the Energy Agency have a program that has around 13,000 of these project managers. We're talking about taking things up by a factor of 10 here. There are 138,000 bank branches in the EU. So if you can imagine all of those bank branches would only have to train 3 project managers if 350 renovation project managers was to work. So when you put it at the scale of the bank branches, I think these challenges become much more achievable. Next slide, please. I'm happy to say that the ITRE committee in the Parliament have noticed the need for an EU renovation loan. The box on this slide seemed to have slipped. It was supposed to be over. So it calls for a special renovation instrument by name, the EU renovation loan. Next slide. And the ERL, I think, fits very neatly into a mortgage portfolio standard framework, which is a regulatory lever already in the recast Energy Performance in Buildings Directive, Article 15.4, which was what Robert referred to in the sense that there are existing tools that are already being negotiated that will promote engagement by financial institutions and mortgage lenders to identify and help finance buildings in their portfolio. But hopefully, as we'll hear later, they do need some extra support in terms of being able to offer the right packages of finance. Next slide. So I think that the ERL, together with the mortgage portfolio standard, certainly will facilitate minimum energy performance standards, which at the end of the day is the upcoming limit by which buildings owners will have to change their attitude with respect of realizing that an inefficient home has a limited shelf life. Next slide. So just closing, there are 6 takeaway conclusions from this report. The first is that we need to be delivering 3.5 million deep renovations every year. That can only be unlocked, I argue, by tapping into the huge amount of home equity savings that there are, 10 trillion of that. We don't need all of that. We need about 10% of that to cover the EU renovation wave. We need a standardized offer that is made by thousands of approved lenders to millions of clients. We can use existing components such as zero coupon design, an EU guarantee, and some liquidity from the European Central Bank. This will align the interests of lenders together with those of the EU institutions and customers, and it'll provide the confidence that member states need to train and engage project managers and to revitalize renovation supply chains. And my last slide says, in order to achieve all of that, I think that, as we heard from Robert, the technical task force can certainly needs to help take this blueprint we're launching today and make it and bring the pieces together and make it real to those mortgage lenders. And I think that can be done in the context and in parallel of the final negotiations that Claude mentioned with respect to the European Performance of Buildings Directive, which in large degree can provide the ERL facilitation framework that I've described. Retail lenders must urgently address their mortgage portfolio climate risks, because we can't have stranded assets and we can't have customers who want to do renovations but can't access the right financing. And finally, we need to make sure there are no financial and prudential regulations that are blocking any of this. And there are some facilitations that could be done to, as I've mentioned, the mortgage credit directive to support this transition. So with that, I thank you for listening. You can sort of put your phone towards the screen and you can download the report. Please follow us on Twitter at ClimateST, and we will be happy. I'll be happy to take your questions later. Thank you.